What most people don't realize is that the gold sitting in their bank's safe deposit box isn't actually theirs anymore, not in the way they think. And what I'm about to show you is going to fundamentally change how you think about storing precious metals. Let me start with something that happened just weeks ago that barely made the news. A regional bank in the Midwest quietly updated their safe deposit box terms and conditions. Buried in paragraph 17 of the new agreement was a single sentence that should terrify anyone storing gold in a bank. It stated that in the event of a bank resolution or restructuring, the contents of safe deposit boxes could be subject to the same bail-in provisions as deposit accounts. Most customers signed the updated agreement without reading it. They had no idea what they just agreed to. Now, before you think this is some isolated incident or conspiracy theory, let me walk you through exactly what's happening in the banking system right now and why your gold is more vulnerable than it's ever been. Because this isn't about one bank. This is about a fundamental shift in how the entire financial system views private property during times of crisis. Here's what you need to understand about bail-ins. After the financial crisis, regulators around the world decided that taxpayers shouldn't be on the hook for bank failures anymore. Makes sense, right? But their solution was to create a mechanism where banks could essentially confiscate customer assets to recapitalize themselves during a crisis. They call it a bail-in. Cyprus was the test case back in 2013. Depositors woke up one morning to find that a significant portion of their bank accounts had been converted to bank equity. Their cash became worthless shares in a failing institution overnight. But here's what most people missed about Cyprus. It wasn't just deposit accounts. Safe deposit boxes were frozen. Access was denied. And while the government claimed they were only going after cash deposits, the precedent was set. During a banking crisis, everything inside the bank becomes fair game. The legal framework exists. The mechanisms are in place. And now, banks are quietly updating their terms to make sure they're covered when it happens again. Think about what a safe deposit box really is. You're renting space inside a private institution. You don't own that vault. You don't control access to it. The bank does. And when a bank fails or faces a liquidity crisis, who do you think gets priority? The FDIC, the regulators, the secured creditors, or you with your little key in your rental agreement? I'll give you a hint. You're at the bottom of that list. Now let me show you something even more concerning. There's a difference between allocated and unallocated gold storage. Most people don't know this distinction exists, and it's costing them everything. When you store gold in a bank's vault program, not a safe deposit box, but their actual precious metals storage service, you need to ask one critical question. Is this allocated or unallocated storage? Allocated means you own specific bars with specific serial numbers. That gold is segregated and belongs to you. Unallocated means you own a claim on a certain amount of gold, but the bank doesn't set aside specific bars for you. Your gold is pooled with everyone else's. And here's the kicker. In an unallocated arrangement, you're an unsecured creditor of the bank. If that bank fails, you're standing in line with everyone else hoping there's something left after the secured creditors take their cut. Quick aside here, because this is important. If you're watching this and you've got retirement savings sitting in traditional accounts, there's a free guide in the description that breaks down how thousands of American retirees are protecting their wealth from exactly these kinds of systemic risks. Worth checking out while you're thinking about this stuff. But back to the banks. Let me tell you about what happened with MF Global. This was a major brokerage firm that collapsed back in 2011. They had customer gold stored in their vaults, allocated gold, specific bars with serial numbers that belonged to specific customers. When MF Global went bankrupt, you know what happened? That gold was frozen. Customers couldn't access it. It took years of legal battles for some of them to get their property back. And these were sophisticated investors with allocated storage agreements and legal documentation proving ownership. If it can happen to them, what makes you think your safe deposit box is protected? Here's another angle most people never consider. Civil asset forfeiture. Law enforcement can seize property suspected of being connected to criminal activity without ever charging you with a crime. And safe deposit boxes are prime targets. There have been multiple cases where the FBI or DEA raided banks, drilled open every safe deposit box and seized the contents. The owners had to prove their property wasn't connected to any crime to get it back. Guilty until proven innocent. Your gold, your family heirlooms, your emergency cash, all gone until you can afford a lawyer and fight the government for months or years. The most famous recent case involved a bank in Los Angeles. The FBI raided it as part of a money laundering investigation against the bank itself. They opened over 1,400 safe deposit boxes. They seized everything: cash, gold, jewelry, family documents. The box holders weren't accused of any crimes. They weren't even notified before the raid. They showed up to access their boxes and found them empty. The government's position was that anyone storing valuables in that particular bank must have been involved in criminal activity. Prove otherwise. Now, I want you to think about the current banking crisis for a moment. We've already seen bank failures this year. The FDIC is managing multiple resolutions. Unrealized losses on bank balance sheets are sitting at levels we haven't seen since 2008. When the next wave hits, and it will hit, what do you think happens to safe deposit box access? The bank closes. The FDIC takes over. You can't get in. Your gold might as well be on the moon. And here's something that should really concern you. The legal status of safe deposit box contents is murky at best. Most people think of it like a storage unit. You rent the space, you own what's inside, end of story. But banks don't see it that way. In their terms of service, which nobody reads, they often disclaim responsibility for the contents. They're not bailies in the legal sense. They're not warehouses. They're just renting you access to a space. If something happens to that space or its contents, their liability is limited to the rental fee you paid. Your gold could be worth hundreds of thousands of dollars. Their liability might be capped at a few $100 a year. Let me paint you a picture of how this plays out in a real crisis scenario. The banking system is under stress. Liquidity is tight. Rumors are spreading. People start lining up to withdraw cash. The government steps in with emergency measures. Banks are closed temporarily for a bank holiday. When they reopen, new rules are in place: capital controls, withdrawal limits, and safe deposit box access is restricted. You need to make an appointment. You need to provide documentation. You need to explain why you need access to your own property. This isn't speculation. This is exactly what happened in Greece during their crisis. Safe deposit boxes were effectively frozen. People couldn't access them without jumping through hoops and providing justification. The government wanted to make sure nobody was pulling out cash or valuables to avoid the haircuts being imposed on the banking system. Your property became a tool of monetary policy. Now let's talk about the elephant in the room: gold confiscation. Everyone knows about 1933 and Executive Order 6102. Roosevelt ordered Americans to turn in their gold. Most people did. Those who didn't faced serious penalties. But here's what's different now. The government doesn't need to go door to door looking for gold. They don't need to search homes or interrogate citizens. All they need to do is control the banks. Because if your gold is in a bank, they already know where it is. They already have access to it. They can freeze it, seize it, or revalue it with the stroke of a pen. Think about the mechanics of a modern confiscation. It wouldn't look like 1933. It would be much more subtle. The government declares a banking emergency. Safe deposit boxes are frozen for audit purposes. They're checking for unreported assets, tax evasion, money laundering, whatever justification they need. Your box gets opened. The contents are cataloged, and then you get a letter. Your gold has been seized pending investigation, or it's been converted to a digital gold certificate at a government-determined price, or it's being held as collateral against the national debt. The legal mechanisms exist to do all of this. And before you think this is just American paranoia, look at what's happening globally. India has conducted multiple gold raids on private citizens. China restricts gold ownership and movement. The European Union has implemented cash and gold transaction reporting requirements that make it nearly impossible to move significant amounts of precious metals without government knowledge. The trend is clear. Governments want to know where the gold is, and they want the ability to control it when they need to. Here's another risk nobody talks about: bank employees. The people who work at your bank have access to information about safe deposit boxes. They know who has them. They know roughly when people access them. In some cases, they can see records of what was declared when the box was rented. This information has value, and in times of economic stress, desperate people do desperate things. There have been cases of bank employees tipping off criminals about safe deposit box contents. There have been cases of employees themselves accessing boxes. Your security is only as good as the weakest link in that bank's employment chain. Let me tell you about something that happened in London. A professional safe deposit box facility, not even a bank, was robbed. The thieves had inside information. They knew which boxes contained the most valuable items. They knew the security protocols. They knew when to strike. Customers lost millions in gold, jewelry, and cash. And because it was a private facility with limited insurance, most of them never recovered their losses. If it can happen at a specialized secure facility, it can definitely happen at your local bank branch. Now, I want to shift gears and talk about something that's happening right now in the precious metals market that ties directly into this storage issue. The disconnect between paper gold and physical gold is widening. The COMEX, the London bullion market, these are paper markets. They trade contracts and certificates representing gold. But the amount of paper gold in circulation far exceeds the amount of physical gold that actually exists to back it up. Some estimates put the ratio at 100 to 1 or higher. For every ounce of physical gold, there are 100 ounces of paper claims on gold. What happens when people start demanding physical delivery? What happens when the paper market breaks and everyone realizes their gold certificates are just promises that can't be kept? The banks and institutions holding that physical gold are going to be in a very difficult position. They're going to have far more claims against their gold than they have gold to deliver. And when that happens, whose gold do you think they're going to use to meet those obligations? If your gold is sitting in their vault, even in a safe deposit box, it becomes part of their available inventory in a crisis. This is where the bail-in provisions I mentioned earlier become really dangerous. In a scenario where a bank is facing a run on physical gold, where they have more paper claims than physical metal, they could theoretically use bail-in authority to seize customer gold to meet their obligations. It sounds insane. It sounds illegal. But the legal framework exists. The precedents have been set. And in a crisis, governments and banks will do whatever they need to do to maintain stability, even if it means confiscating private property. Let me give you a specific example of how this could play out. A major bank offers gold storage services. They have both allocated and unallocated programs. Most customers are in unallocated because it's cheaper. The bank has been using that gold for their own purposes, lending it out, using it as collateral, the usual fractional reserve games. Then a crisis hits. Gold prices spike. Everyone wants physical delivery. The bank doesn't have enough gold to meet all the claims. They declare force majeure. They suspend redemptions. And then they go to the regulators and say they need emergency authority to access all gold in their possession, including safe deposit boxes, to meet their obligations and prevent a systemic crisis. The regulators agree because the alternative is a bank failure that could trigger contagion. Your gold, sitting in your safe deposit box, gets swept up in this emergency action. You get a certificate saying you own X amount of gold at Y price, determined by the government. But you can't take physical possession. You can't sell it on the open market. You're stuck with a paper claim on gold that's worth far less than the actual metal would be worth in a crisis environment. Sound far-fetched? It's exactly what happened with gold in 1933. People who owned gold were forced to exchange it for paper dollars at a government-set price. Then, after the confiscation was complete, the government revalued gold at a much higher price. The people who turned in their gold got screwed. The government and the banks made out like bandits. History doesn't repeat, but it sure does rhyme. Now, let's talk about what's happening with central banks right now, because this is crucial context. Central banks around the world are buying gold at record pace. They're repatriating gold from foreign storage. They're building up their reserves. Why? Because they know what's coming. They know the current monetary system is unsustainable. They know that when the reset happens, gold is going to be the ultimate settlement asset. And they want to make sure they have as much of it as possible when that day comes. But here's the thing. Central banks aren't buying gold from the open market at retail prices. They're acquiring it through swaps, through leasing arrangements, through backroom deals with other central banks and major institutions. And where do you think some of that gold is coming from? It's coming from the fractional reserve gold banking system. It's coming from the paper gold market. It's coming from the very institutions where you might be storing your gold. When a central bank does a gold swap with a commercial bank, that commercial bank needs to deliver physical gold. If they don't have enough in their own reserves, where do they get it? They pull it from customer accounts. They pull it from unallocated storage. And if push comes to shove, they'll find legal justifications to pull it from allocated storage and safe deposit boxes too. Their gold becomes the central bank's gold, and you're left holding a paper claim that's worth whatever they decide it's worth. Here's another angle that's deeply concerning: the push towards central bank digital currencies. Every major economy is working on a CBDC. The stated goal is efficiency, financial inclusion, all the usual buzzwords. But the real goal is control. A CBDC gives the government complete visibility into every transaction. It gives them the ability to program money, to set expiration dates, to restrict what you can buy, to implement negative interest rates, to confiscate funds instantly without due process. And what's the biggest threat to a CBDC system? Physical assets that exist outside the digital control grid: cash and gold. If the government is going to implement a CBDC and force everyone to use it, they need to eliminate alternatives. They need to make sure people can't opt out by holding physical wealth. That means going after cash. And it means going after gold, especially gold that's stored in locations they can easily access, like banks. Think about the timeline here. We're seeing increasing restrictions on cash transactions. We're seeing banks report gold purchases to the government. We're seeing safe deposit box terms being updated to give banks more authority over contents. We're seeing the legal framework for bail-ins being put in place. We're seeing central banks accumulating gold while telling the public it's a barbarous relic. All of these pieces are moving in the same direction. They're preparing for a reset, and they're making sure that when it happens, they control the gold. Now, I know some of you are thinking, this is all very concerning, but what's the alternative? If I can't store gold in a bank, where do I store it? And that's a fair question. But before we get to solutions, I want to make sure you understand the full scope of the problem. Because it's not just about storage. It's about the entire structure of the precious metals market and how it's designed to separate you from your wealth. Let me tell you about the LBMA, the London Bullion Market Association. This is where most of the world's gold trading happens. It's an over-the-counter market, meaning there's no central exchange. It's just a network of banks and dealers trading gold amongst themselves, and the vast majority of that trading is unallocated. It's paper gold. It's credits and debits on ledgers. Very little physical metal actually moves. The LBMA has a system called the Good Delivery List. These are the refiners and bars that meet their standards. If you want to trade gold in the LBMA system, it needs to be good delivery bars. These are 400-ounce bars, roughly 12.5 kilograms each. They're huge. They're expensive. They're not practical for individual investors. So what do individuals do? They buy smaller bars and coins. And where do they often store them? In banks, in the very system that's designed to keep them away from the physical metal. Here's the scam. The big players, the central banks, the sovereign wealth funds, the major institutions, they deal in physical. They take delivery of good delivery bars. They store them in allocated accounts where they own specific bars with specific serial numbers. They have audits, they have insurance, they have security. But retail investors, they get paper gold. They get ETFs that may or may not have the gold they claim to have. They get unallocated storage where they're unsecured creditors. They get safe deposit boxes in banks that can be frozen or seized at any moment. It's a two-tiered system. The elites get real gold. The masses get paper promises. And when the crisis comes, when the paper market breaks, guess who's going to be left holding the bag? It's not going to be the central banks. It's not going to be the sovereign wealth funds. It's going to be the retail investors who thought they were protecting themselves by buying gold, but who never actually took possession of physical metal. Now let me talk about insurance for a moment, because this is another area where people have a false sense of security. Most banks offer very limited insurance on safe deposit box contents. We're talking maybe a few $1,000s maximum. If you have significant gold holdings in a safe deposit box, you're massively underinsured. And good luck trying to get private insurance for gold stored in a bank. Most insurance companies won't touch it because they know the risks. But even if you do have insurance, read the fine print. Most policies exclude losses due to government action, war, civil unrest, bank failure, or force majeure events. In other words, all the scenarios where you'd actually need the insurance are specifically excluded. The insurance is basically worthless. It might cover you if there's a fire or a flood, but it's not going to help you if the government seizes your gold or the bank goes under. And speaking of bank failures, let me walk you through what actually happens when a bank fails. The FDIC takes over. They freeze all accounts. They assess the situation. They either find a buyer for the bank or they liquidate it. During this process, which can take months or even years, you have no access to your safe deposit box. None. You can't get in. You can't retrieve your property. You're completely locked out. When the process is finally complete, if you're lucky, you'll be allowed to access your box and remove your contents. But there's no guarantee. There have been cases where safe deposit box contents were auctioned off to pay creditors. There have been cases where contents were lost or misplaced during the transition. There have been cases where the FDIC claimed the contents as assets of the failed bank. Your gold could disappear into a bureaucratic black hole, and there's very little you can do about it. Let me give you a real example. A bank in California failed during the financial crisis. It had hundreds of safe deposit boxes. The FDIC took over. Customers were told they'd be able to access their boxes within a few weeks. Weeks turned into months. Months turned into years. Some customers never got their property back. Others got it back damaged or incomplete. The FDIC's position was that they were not responsible for the contents of safe deposit boxes, only for insured deposits. The customers had no recourse. Now, here's where this gets really interesting from a wealth protection standpoint. If you're sitting on significant retirement savings and you're worried about all of this, there are ways to hold physical gold inside retirement accounts without these risks. I put together a comprehensive guide on how gold IRAs work. It's in the description. It covers how to get physical gold into your retirement account, how to ensure it's properly allocated and stored outside the banking system, and how to do it without triggering tax penalties. If you've got $100,000 or more in retirement accounts, this is worth looking into, because the same risks that apply to gold in safe deposit boxes apply to paper assets in traditional retirement accounts. When the system resets, you want to be holding real assets, not paper promises. But let me get back to the broader point. The banking system is not designed to protect your wealth. It's designed to control it. Every regulation, every policy, every term of service update is moving in the direction of giving banks and governments more authority over your assets and less protection for your property rights. And gold, because it's the ultimate form of wealth that exists outside their control, is a primary target. Think about what gold represents. It's money that can't be printed. It's wealth that can't be inflated away. It's an asset that doesn't depend on anyone's promise or guarantee. It just is. It has value because of its physical properties and its 5,000-year history as money. And that makes it dangerous to a system that's built on debt, on fiat currency, on the ability to create money out of thin air and use inflation to transfer wealth from savers to debtors. The people running the system know that if there's a widespread loss of confidence in fiat currency, people will flee to gold. They'll want physical metal. And if that happens, the paper gold market will collapse. The fractional reserve gold banking system will be exposed as a fraud. And the price of physical gold will go to levels that make current prices look like a joke. They can't allow that to happen. So they need to control the gold. They need to make sure that when the crisis comes, they have access to as much physical metal as possible. And that means going after gold in banks. Here's another scenario that keeps me up at night. Negative interest rates. Several countries have already experimented with them. The idea is that instead of earning interest on your deposits, you pay the bank to hold your money. It's a way to force people to spend rather than save. But what happens when negative interest rates go deeply negative? What happens when the penalty for holding cash in a bank becomes so severe that people start pulling their money out? The government's response will be to restrict cash, to make it harder to withdraw large amounts, to implement capital controls, and to go after alternative stores of value, like gold. If you have gold in a safe deposit box, they know where it is. They can tax it. They can seize it. They can force you to convert it to digital currency at a government-set price. your safe deposit box becomes a trap.